Chapter 12, Itemized Deductions. The following forms and publications were used in the research and development of this lesson. Forms and publications are available at www.irs.gov. The primary form utilized with itemized deductions is Schedule A. At the end of this lesson, the student will be able to define Schedule A phase-out limits, if any. What does the term the floor mean? What deductions are limited by the 7.5% floor? What deductions are limited to the 2% floor? How to calculate the floor and phase-outs from the taxpayer's AGI. The taxpayer must decide whether to itemize deductions or use the standard deduction. Generally speaking, experience will tell you unless someone has a mortgage on their property and are making payments on their mortgage, they don't usually have enough itemized deductions to go that route and will benefit more from the standard deduction. Generally speaking, but not always the case. Taxpayers should itemize deductions if the allowable itemized deductions are more than the standard deduction. And that is always the challenge, and easy to do with, and doesn't take much time to sit with a client and review. I had one client came in and was all excited because they had donated their car to a qualifying charity, had received the form that indicated the value was $1,300, and of course was told that she could deduct this on her taxes. Unfortunately, she had no other itemized deductions enough to warrant using itemized deductions. Standard deduction was still a greater amount of deduction. It was quite challenging to help her understand it's one or the other. She, of course, would rather have both. Taxpayers not eligible to use the standard deduction are non-resident aliens, dual status aliens, and individuals who file returns for periods of less than 12 months. Taxpayers should itemize if they meet the following criteria: if they do not qualify for the standard deduction, or have large unreimbursed medical or dental expenses. That's another one I look for, because even if they don't have a mortgage, that may mean that standard deduction is greater. It's possible with the large amount of medical or dental expenses, it would still be greater to go with itemized deductions. Obviously, the big one we see is paid mortgage interest, or have a large unreimbursed employee business expenses. I have several correctional officers that fall under that category. A lot of business expenses with their work that they pay for out of pocket that allows them and makes the itemized deductions amount larger. Or made large contributions to qualified charities. There's another one that could potentially. It's never a bad thing. It's always an easy, quick thing to do. If the client thinks that they're going to benefit better, go through a quick exercise. Open up a Schedule A, ask them the questions, enter the information under each category. Most of the time, my experience shows that even when they think they qualify, once you go through the exercise and show them the bottom line, they will at least then understand, no, they're still better off with standard deduction. But itemized deductions have to be higher than the standard deduction for their filing status. Makes sense. Now, married filing separate taxpayers is a unique category. If the taxpayers are married filing separate and one spouse itemizes, the other spouse must itemize regardless of the fact that their total deductions may be less than the standard deduction to which they would otherwise be entitled. Again, experience shows that if one benefits from itemized deductions, probably the other spouse does not benefit and will actually be impacted with itemized deductions. But they don't have a choice. The first part of Schedule A, itemized deductions, is medical and dental expenses. Now, this is a tricky one for people because they, of course, want to include everything, which understandable, as even including medical insurance. The problem is, in many cases, the medical insurance is paid out of their payroll and is already on a pre-tax basis, so they're already getting the benefit of it because it's already taken out of their taxable income. And that's not always easy to show unless their paycheck is done by ADP, because those pay stubs and those W-2s do show the total income, including what they paid for their CAFE plans, and that's CAFE meaning and standing for medical and dental and possibly vision insurance premiums. So with that, it's helpful to demonstrate to them that they've already received the tax benefit up front pre-tax, which is why that is done through the payroll deductions. So that cannot be included unless, and the best question to ask is, do you write a monthly check to an insurance company for medical? No, it comes out of my payroll. Bingo. There's your clue then if you add it or not add it. Other than that, medical and dental expenses do have a cap, and that is, if you see there on line 3, the 7.5%. Another term for a cap is a minimum cap or the floor. Medical care expenses can be deducted if amounts are paid for the diagnosis, cure, treatment, or prevention of a disease or ailments affecting any part of or function of the body. Procedures such as facelifts, hair transplants, hair removal, and liposuction generally are not deductible. Cosmetic surgery is only deductible if it is to improve a deformity arising from or directly related to a congenital abnormality, a personal injury resulting from an accident or trauma, or a disfiguring disease. One that we run across fairly often is tattoo removals. So a person has had a tattoo and has decided that they don't want the tattoo anymore and go and pay for the tattoo to be removed. The question again, whether it's acceptable as a valid medical expense or not, is was it used to improve or you just chose you wanted it removed? For instance, if I have had issues where a person got infected with the tattoo and therefore it was a medical necessity to remove it. But if it's strictly a cosmetic, oh, I like that tattoo, now I've changed my mind, I want it removed, that is not covered under Schedule A. Medications are only deductible if prescribed by a doctor. So certainly if there is some frequent medication, as an example, I have to take heartburn medication, and heartburn medication is over the counter. I asked my doctor if there's a way to get a prescription for the same thing, and they said yes, so now I am getting a prescription for it. And the taxpayer can deduct medical and dental expenses that exceed 7.5% of their AGI, found on line 38, Form 1040. So that's what that is doing here. And when you see under the form of Schedule A, line 1, enter all your medical and dental expenses. Line 2, enter your AGI, adjusted gross income. Line 3, multiply that by 7.5% and then subtract. So only the difference. So, for example, if your AGI is $100,000, the first $7,500 of medical and dental expenses don't help you. It's only the difference that you're able to deduct. So it's a huge amount. Matter of fact, our understanding is next year for 2014, that is going to be increased to 10%. So again, same example, if you make $100,000, then you'd have to have medical and dental expenses greater than $10,000 before you could deduct even $1. And in most cases, we find that it's excessive. It's humorous to me the number of clients that come in and say, "Oh, I had a lot of medical expenses this year." Oh, what was your? And before we get in, and many times they'll bring in all the receipts and they're ready to add them all up. I usually will save myself a lot of work by asking the client, "Do you think it's more than $1,000?" And many times, "Oh no, it's not anywhere near that." All right, well let's just say it's 1,000. Since you know it's no way can be more than that. And then I do the formulation here and the calculation on the screen for the Schedule A to determine, okay, see your income and 7.5% means that you'd have to have more than $3,000 before you could deduct anything. And by that point, they're like, "Oh, it's not anywhere near that." And they put the receipts away and you save yourself quite a bit of time. The taxpayer can deduct as medical expenses only those amounts paid during the taxable year for which they received no insurance or other reimbursement. They must reduce their total medical expenses for the year by all reimbursements for medical expenses that were received from insurance or other sources during the year. This includes payments from Medicare. They must be reduced by any reimbursement received for the expenses. Again, to emphasize, only the amount which is above the floor, 7.5%, or I like to call it minimum cap, of the AGI will be deducted if the taxpayer has enough to file Schedule A. Now here's some examples of deductible medical expenses. Medical insurance premiums, including Medicare, that were not paid through payroll. Now that's an important distinction there, because people do, well, I pay medical insurance. Well, sure you do. How is it paid? It comes out of my payroll. Well, then it's already pre-taxed and you haven't paid tax, and your only taxable income is the difference. Dental treatment, prescription medicines, medical service fees, premiums paid for qualified long-term care insurance contracts can be deducted within limits for long-term care insurance. Also, medical miles. Where I live, the closest advanced facility is in Stanford, about 120 miles away. So many situations require commuting or traveling to Stanford and back for treatments. Those are considered medical miles and are also deductible. Premiums paid for qualified long-term care insurance contracts can be deducted within limits for long-term care insurance. Certainly you want to look into more research on the specifics if that applies to you. Fees paid to retirement or nursing homes that are designed for medical care and psychiatric care are deductible. Meals, lodging, and prescriptions are deductible only if the individual is in the home primarily to get medical care. If the main reason the individual is in the home is personal, meals and lodging are not deductible. A deduction may be taken for inpatient treatment at a drug or alcohol therapeutic center for the addiction, and in that case, meals and lodging while at the center are deductible. Now, what is non-deductible that are medical? The biggest one your patients will bring to you, or your clients will bring to you, is over-the-counter medication. That cannot be deducted. Cough syrups, aspirin, anything like that. Expenses for general health items. So if you like to take protein supplements or vitamin supplements, it's not deductible. Health club dues, funeral expenses. That's sad. You'll get that question a few times. I have all these expenses. I had to bury my father. Unfortunately, funeral expenses are not deductible. Insurance premiums paid for life insurance, loss of earnings, limb or sight, guaranteed payments for days the taxpayer is hospitalized for sickness or injury, and the medical insurance coverage portion of the taxpayer's auto insurance are not deductible. Cafeteria plans are not deductible unless the premiums are included in Box 1 of Form W-2. And, of course, they're not. If it's taken out through payroll, it is not included in Box 1. The next section of the Schedule A, after medical and dental expenses, is taxes you paid. What taxes did you pay that you can use as a deduction on your federal taxes? State taxes. If you pay state taxes, those are deductible on the federal. Local taxes, if any, apply. Foreign taxes. How about real estate taxes or property taxes? Even personal property taxes can be deducted by the taxpayer, such as DMV fees. State and local general sales tax can be deducted instead of state and local income taxes as an itemized deduction. That's always a question I ask any client. Did you purchase a new vehicle the previous year? Doesn't have to be brand new, just new to you. And if they say no, generally speaking, the state tax withheld is going to be greater. Now, if you happen to be in a state like Texas where there is no state tax, then obviously the sales tax is the amount you want to include there. Can either deduct actual expenses or an amount figured using the optional state sales tax tables, and that you can find through your 1040 instructions. The optional state sales tax tables is nice because you may be able to add to the table any state and local sales tax paid on motor vehicles, boats, and other items specified in publication 600. So that's why I ask about a newer car. Can be a truck, could be a boat, could be an RV. But though that is not a normal sales tax that a person pays out, so the optional state sales tax tables figures in your AGI and determines you probably spent, based on the percentage of sales tax in your area, an X amount of money for sales tax. If that amount is greater than the state tax withheld from the checks, then sales tax is used instead of state tax. Also, real estate taxes paid. State, local, or foreign real estate taxes paid for real estate owned by the taxpayer, and only if the taxes are based on the assessed value of the property, is deductible. Now, many times this is, and we'll speak about it in a couple of slides, the real estate taxes are paid out through your mortgage in an escrow account, in which case there will be a documentation showing that. If not, then you will rely on your client to bring you the amount of real estate taxes paid. Most people are familiar with this as a viable deduction and bring the county sheets that have the little receipt coupons in there, and it lets you understand and gives you the information you need to enter the right amount of real estate taxes paid. Now, the taxpayer should not include the following items when calculating his real estate tax deduction: itemized charges for services to specific property or person, charges for improvements that tend to increase the value of the property, or if the charges were to repair an existing sidewalk, the charges and any interest would be deductible refunds and rebates of real estate taxes or interest and penalties. So the only two deductible expenses on primary residence is mortgage interest and property taxes or real estate taxes. Then you will have clients come in, they'll have all their receipts for all the repairs they did on their primary residence, and of course the improvements. I would love that we could, and this is how I help them understand, I would love to be able to deduct that on my primary residence. I just spent $12,000 replacing my roof. Unfortunately, it will improve the quality of the home and will help me when I sell it, but at the moment it is not a deduction. Personal property tax. A taxpayer should deduct personal property tax only if it is a state or local tax that meets the following requirements: charged on personal property, your car tags, boat tags, quad tags, motorcycle tags, based only on the value of the personal property and charged on a yearly basis, even if it is collected more than once a year or less than once a year. So DMV fees is what we look at. Foreign taxes. Taxpayers can claim a credit for foreign taxes paid or take it as an itemized deduction under other taxes. Taxpayer may or may not have to complete Form 1116 foreign tax credits if he elects not to deduct his foreign taxes paid on Schedule A as an itemized deduction. The tax professional should always review 1099s for foreign taxes paid. It is a box that you will see either under 1099B or 1099DIV or 1099INT. Any of them, look for the box for foreign tax paid. Interest paid. Now, you always have someone wanting to, you put in here their car interest or their credit card interest. Personal loans, such as cars, such as credit cards, are never a deduction. You cannot deduct that interest. But home mortgage interest and points, absolutely. Now, this is critical because to be able to put home mortgage interest in here, you really need to see Form 1098. And many times your clients will have them. Once in a while, you'll get a client who does not have. Say, well, I haven't received it. Well, I've got to have it because That form goes to the IRS, and it has the information of whose name appears on the loan and the exact amount of interest paid out. Now, it's possible that you have a client, and I have several, who bought the house in connection with a brother. And therefore, the brother's name may appear on the loan, and they're qualified for half. So it's important that you double check and know that all the interest on that 1098 is going to have the full portion, and then the client's telling you only half applies to them. And that's perfectly fine. Home mortgage interest and points are deductible on a main home and a second home. The home acquisition and home equity debt dollar limit apply to the total mortgage on both homes. So I have many clients who have a rental, have a home, not a rental, a main home, primary residence, and a vacation home, say up at Lake Tahoe, from not too far from here. Now, Form 1098 mortgage interest statement usually includes the amount of points paid mortgage interest and real estate taxes if it's held in an escrow account. Otherwise, like I said, they will bring you the separate statements. If your client does not bring you a 1098, it's possible, and what I've done many times, is to look it up online. But if it's not possible to look it up online, you need to, unfortunately, have your client return once they get that 1098, or have them call the bank or the lending institution to see if you get someone to tell you that exact amount. But we need the exact amount because that's the information that's going to the IRS. So points, often called loan origination fees, maximum loan charges, loan discount, loan placement fees, or discount points, are really prepaid interest. Points that the seller pays for the borrower are treated as being paid by the borrower. Generally, the full amount of points paid cannot be deducted in the year paid. Because they are prepaid interest, they must generally be deducted over the life of the mortgage. So invariably, you have to include that, and it ends up being like a $30 to $50 per year on their tax return for the next 30 years. Investment interest is interest paid on money borrowed that is attributable to property held for investment. It does not include any interest related to passive activities such as rental homes or to securities that generate tax-exempt income. Investment interest does not include any qualified home mortgage interest or any interest taken into account in computing income or loss from a passive activity. A passive activity, again, if you remember, rental homes. The next section of Schedule A, Itemized Deductions, is gifts to charity. The IRS separates donations to charity by cash or non-cash or other than cash. Meaning cash, now when you tell somebody cash, well, I write a check, that's cash. That's considered cash. Some churches are even going to a credit card, debit card system to where they pass through, instead of a plate, they pass the little machine. You can scan your card and put in the amount that you want to give. And therefore, that is still considered cash. Otherwise, other than cash. And so I always ask my clients, cash, charity, non-cash, meaning clothing, furniture, anything, or old computer, anything that you may have donated to charity. One key point has to do, it must be a recognized charitable organization. So Salvation Army, Red Cross, Goodwill, these are recognized charitable organizations. If they are not 50c3 companies, which is a charitable organization, then you can't just give it. You can't give it to your Aunt Jane in Oklahoma. She's not considered a charitable organization unless she does have a not-for-profit organization, and license. It's possible, but they would have to have that. Contributions of money or property, such as clothing, to qualified organizations may be deducted. Not deductible are dues, fees, or bills to clubs, lodges, fraternal orders, civic leagues, political groups, for-profit organizations, or similar groups. Also not deductible are gifts of money or property to an individual. such as a local collection to help a child receive an expensive medical treatment. And that sounds sad, but again, that's not a charitable organization. Perhaps in lieu of giving, find out where the child is being treated and give a donation to the hospital or to the medical group that is treating them. Also, the taxpayer may be able to deduct contributions to certain Mexican and Canadian charitable organizations under an income tax treaty with Mexico and Canada. The organization must meet tests that are essentially the same as the tests that qualify U.S. organizations to receive deductible contributions. The organization may be able to tell you if they meet the necessary test. One of the challenges, too, when you ask clients about cash donations, they will usually talk about how they put $5 to $10 in the plate on Sunday mornings at church as an example, and make sure they understand the importance of having some type of a paper trail, or you've got to have some kind of record that you actually donated. So advise them not to just put cash in there, but to write a check, or if their church provides envelopes, put envelopes in, put the money in envelopes and put your name on it. Therefore, it will come back to you at the end of the year in a charitable statement, contribution statement that will will be a document showing that how much you did donate, because it's all has to be proved. Now, another issue does have to do with casualty and theft losses, and attach Form 4684. And all of these usually have an additional form to attach. Not all of them, but many of them do. Now, casualty is the damage, destruction, or loss of property resulting from an identifiable event that is sudden, unexpected, or unusual. The tornado in Oklahoma is a very good example. Very sudden, unexpected, and unusual. A loss on deposits can occur when a bank, credit union, or other financial institution becomes insolvent or bankrupt. When property is damaged or destroyed as a result of hurricanes, earthquakes, tornadoes, fires, vandalism, car accidents, and similar events, it is called a casualty loss. A casualty loss must be sudden and unexpected. Therefore, termite damage would not qualify. Taxpayer will need to complete Form 4684, Casualty and Theft, and attach it to his return. The other limitation is in the minimum amount. I had a good friend of mine, who had his home broken into, and they stole about $1,500 worth of personal belongings. Now, he had insurance that covered it up to $1,000 deductible, so he had $1,000. The minimum that cap on what can be included under casualty and theft is 10% of adjusted gross income. As he and his wife combined make $100,000 a year, that meant the minimum to even enter a dollar amount under casualty and theft would for him have to have been $10,000. So it doesn't really benefit him. I don't think I've ever done a return where someone had a big enough loss that they would actually be able to include it in their tax return. Apparently, it looks like many and more Oklahoma will this year. The next section is job expenses and certain miscellaneous deductions. Now, these expenses for job expenses, these are not self-employed people. That is for Schedule C. This is for you are an employee, but there are certain expenses that are not paid by your employer. You pay them. I know of many life insurance salesmen who do a lot of traveling, extensive traveling, and none of those expenses are paid for or reimbursed by the parent company. He makes commission on it, but he is still considered an employee. He is not self-employed. So as a W-2 employee, he has expenses that are not reimbursed. A good example is here in the state of California, correctional officers. Correctional officers must provide and pay for their own uniforms. There is specific requirements. They're very expensive, so they're able to deduct those uniforms. Cleaning fees, requirements for grooming. They're required to have and be on call 24 hours a day, so they're required to have a cell phone with them at all times, and yet they do not provide a cell phone. So here are valid job-related expenses that They, of course, must keep track of all the receipts on it and are able to include them under this category of job expenses and certain miscellaneous deductions. One of the problems with this particular form is it's subject to 2% floor, or there's a minimum cap. So as you saw, one of the line items is tax preparation fees. Now, if that's the only thing someone has as tax preparation fees, they usually cannot, that's not helping them because it's less than the minimum 2%. So miscellaneous expenses may or may not be subject to a 2% limitation. Normally they are, depending on the type of deduction. Only those miscellaneous expenses that exceed 2% of the taxpayer's adjusted gross income can be deducted. This effectively removes the deduction for most taxpayers. It really does. But for instance, the correctional officers, they mostly have all those viable expenses, plus union dues. That's another one that you can include here. And uniforms, that's nurses and doctors, scrubs. These are all viable expenses that they can deduct. Now, the last little category under the Schedule A is other miscellaneous deductions. Now, there is a list. Look at the list in the 1040 instructions for a complete detail. There's a lot of tiny little things that don't generally apply to most people. One that can is gambling losses. Now, I always get a giggle from my clients when I mention, how much did you have in gambling losses? And they're like, oh my. Well, obviously some say I never gamble. Others say, oh my, I don't even want to try to count that up. The tricky part with this one is that it's only losses up to the amount of gambling winnings, which is always confusing to people because if there were no winnings, then there are no losses to deduct. The example I give is the gentleman who walks in and typically when people go to gamble, it's for entertainment. So they're spending money, and so they've spent a couple of $1,000, and then he hits the jackpot and wins $1,000. So he's all excited. He won $1,000. He goes home and tells his family and his friends, hey, I won $1,000 in Vegas. Did he really win $1,000? No, he actually still came out having spent $1,000 because he totally spent $2,000, but did get a jackpot of $1,000. So he's still in the hole. That's where I've learned when people say they come back from Vegas and they break even. They didn't break even. They're not building billion-dollar hotels because people leave breaking even. He's just saying that he didn't spend any more money than what he had planned on spending. And that's fine. That's good entertainment. They enjoy it. But it is important under the tax return. You must report the full amount of gambling winnings for the year. You will get a W-2G. That information is entered, then you see that income, and we talked about it for line 21 of the 1040. And then you may deduct your losses no more than winnings on line 28 of Schedule A. You cannot reduce your gambling winnings by gambling losses and then just report the difference. You must report the full amount of winnings as income and claim losses up to the amount of winnings. I also remind my clients that the IRS can always ask you to prove that. For instance, if my client says, "Hey, I got lucky on the scratch tickets and I won $1 million. I want to put on the return that I lost $1 million as well." Well, I think the IRS will probably want you to prove that. Most people, especially if their incomes, if they don't have much, if they're not showing any money in savings accounts and they make $50,000 a year, I would be suspect that he had spent $1 million to win $1 million. So I do advise people all losses must be proven. And of course, that's usually the question I get back. How do I prove that? And I say, well, I don't know because I personally don't gamble. But by all means, you need to double check wherever you go. Ask them, how can I prove what I've spent? I'm sure they have a method calculated for you and figured out for you to track any gambling losses, just so then in case you do win, you can use those and you have your proof. At the end of Schedule A, then, you have total itemized deductions. Add the amounts in the far right column for lines 4 through 28. Also enter this amount on Form 1040, line 40. There have been in the past limitations if you had phase-out amounts. So if you made over a certain amount of money, and I believe it was $125,000, a portion of your deductions could be reduced. That has not into play for 2012 and going forward. Also, if you elect to itemize deductions, even though they are less than your standard, check here. I have never had anybody fill that out. I've never seen anybody really, truly wishing to put in a lower amount. Invariably, they're going to want and include whichever is the greater amount. Another fun issue is when, for whatever reason, a particular year, someone has more deductions than their income. It is possible with mortgage loans being paid off or refinanced that a 1098 might actually show more interest paid than what they actually make in a year. Because once the deduction is applied and the taxable income turns to zero, there is nothing else to deduct. You can't go below zero. And it's been humorous to try to help the clients understand there is no more to deduct. Well, I've got more to deduct. They're pulling out receipts. They've got property taxes. They've got all these things. And I usually just end up going ahead and entering it for them because it makes them feel better about it. But it really doesn't matter. The goal of it, of course, is to get to as close to zero taxable income as possible. And if they're already there, you're done. There's nothing else to deduct. That concludes itemized deductions. Your homework is to do Chapter 12 review questions and TPAs online and read Chapter 13 for next one. Thank you.